All right. A little button says we're live, so I think we're live. I also do see a chat box here, so if I'm not live or there are problems, you guys can just put into the chat. But good afternoon, everyone, and great to be here. My name is JJ Bowman. I'm with John Hancock, our head of distribution strategy and operations. And first, want to just thank Brandon and Doug for inviting me to speak with everybody today. And thank you, everybody, for joining this call. I really appreciate the opportunity to speak with you. And more important, we really appreciate the opportunity to partner with you in selling, what is one of the most important things a person can own in their lives, which is a life insurance policy. So, on behalf of Brooks Tingle, our CEO, and Linda Levine, our head of sales and distribution, and of course, Rich Brandeis, who's with us today, and your regional vice president, I just want to say thank you for joining us and thank you for your business. So today, I'm going to speak on a few topics. Brandon asked me to speak on AG-49 and Section 7702. So a couple, sort of jarble of numbers and letters that really are impacting insurance business in 2021. So I'll speak to both of those. AG-49A is a very recent change, happened it's been going on for a while. It was effective in December, which changes how indexed UL illustrations are run. And then Section 7702, as you probably are familiar with, that is the section of the tax code that governs what constitutes life insurance and what constitutes what's called a modified endowment contract or a MEC. And that was actually updated on December 27th. So some really late-breaking items at the end of the year that I'll go into. But I also want to speak on some of the major trends that we're seeing, what our outlook is at John Hancock, and our kind of perspective on the big trends we've all been feeling over the last 5 years, or last year, as it pertains to life insurance. So let's get started here. So AG-49A, we'll start here, and I'll try to give you a sort of a brief summary on this, and then at the end we'll definitely have a Q&A. So please be welcome, put in any questions that you do have here. But what was the goal of AG-49A? What did the committee set out to do, with regard to it? Well, very simply, the goal of AG-49A was to fix AG-49. So what's AG-49? AG-49 was Actuarial Guideline 49, adopted by the NAIC, I think it was 2015, and it was supposed to standardize the way that index UL illustrations are presented to customers. And it was very successful in part and very unsuccessful in another part. There was one giant loophole that it sort of left outstanding. Where it was successful is AG-49 really helped standardize how we illustrate S&P 500 and other benchmark returns and how we calculate those returns. So that was a really big benefit of it. There was a lot of sort of Wild West style in terms of how they accounted for the equity returns. That was simplified with AG-49. But what it didn't account for was how to quantify the source of IUL funding, which would be your general account and policy charges, or as we often call when we're developing products, we'll call that the options budget. So how much money do we have to sort of fund the indexed UL performance? The big thing that AG-49 left out was it didn't address how you factor policy charges into those look-back rate and calculations. And so what that created was an opportunity to create higher policy charges and better indexed UL performance. And it was something that really, a couple companies acted quickly, made some really aggressive product design choices, and then I think the rest of the industry sort of caught up there. And created an issue, I think, both for you as a producer and for customers. I will say, I don't think there's anything wrong with adding policy charges to improve performance. I think really what happens is to make sure, just do customers really understand what they're getting, and do you have the tools you need to explain what's going on with the customers? And I think that was really the issue with AG-49. So AG-49A came along, and the goal was to really standardize all aspects of the illustration. And did they meet that goal? I think that's a big question. To me, the answer is yes. I think now with indexed UL, the performance is truly linked to that fundamental performance driver, which is the general account return. And I think now you can see small differences between indexed ULs, in how they have, if they have a what's called a multiplier, if they're using charges to fund performance. But sort of the variety of performance-related returns you can see because of charges has been really condensed. And so I think AG-49A was successful in really reducing that sort of discrepancy in how companies can use policy charges to create better illustrated value. So that's sort of a quick summary of what happened with AG-49. But I want to take a step back and talk a little bit about the history and a little bit broader about the history so that we can kind of understand how we got here. Because I think if you understand the history of AG-49A and how we got to this point, I think it also helps you understand indexed UL itself. And most important, I think it helps you understand the real fundamental intrinsic value with indexed UL. And I don't think as an industry we're doing ourselves a service over the past few years with this sort of arms race in terms of illustrated performance and policy charges. And I think we're in a much better place now. So if you've been sort of hesitant on the indexed UL or you haven't been an adopter, I think this is a really great time to take a look at it, even in these low interest rate times. So just to kind of step back in terms of the history here, how did we get here? The history of indexed UL illustration regulation really focuses on two questions. The first is, how do we standardize how indexed UL is presented across companies? And the second question is, what's the best way to link illustrated performance to the company's portfolio rate that actually supports the performance of the product? On that first question, how do we standardize how indexed UL is presented across companies? It helps to see how IUL illustrations evolved. So indexed UL was created in the 1990s. It's been around since the 1990s. It's a great product. It has real customer value. The basic proposition of indexed UL is that it's current assumption UL with a twist. And that twist is, instead of taking just a fixed portfolio return, taking a spread and applying a credit, you can now take that fixed portfolio return, use it to purchase options against the S&P 500, let's say, and that gives you some exposure to equity returns. It doesn't turn you into a variable product, but it's a good way to sort of illustrate or to perform, better than a current assumption UL. And really, anybody who believes that equities are going to outperform bonds over the long term is likely going to be comfortable with an indexed UL strategy, because you're just taking some of that fixed UL, basically going from like 100% underlying asset of fixed UL to creating a blend of bonds and equities. And if you believe that equities are going to outperform bonds, you should be comfortable illustrating an indexed UL that is sort of outperforming your generic current assumption UL. I think it's very important, though, to stop there and remember that indexed UL is still general account universal life insurance. It's not variable insurance. It's not an equity. And I think we do a disservice as an industry if we're going to try to really push those extreme views of IUL. So to illustrate the upside, originally, if you recall, if you've been selling indexed UL or competing against it for a long time, those first iterations used what was called backtesting, and every company had their own way of backtesting. Backtesting just means you look at how did the S&P 500 do over the last 25, 20, 30, 35 years, and we're going to use that as a way to create our maximum illustrated rate. That's a fine way of doing it. The big problem with the industry is there was no common way to do backtesting, and so you could have an illustration from company A and company B. They could be using the exact same indexed, S&P 500, the exact same parameters, but one's going to out-illustrate just because they chose, let's say, a 20-year look back versus a 45-year look back. Makes it very difficult for you as the producer to explain that to a customer and to understand and to be able to compare across companies. This is where the original AG-49 really, really helped. it kind of took away a lot of that confusion or sort of gamesmanship in terms of which index to use, what look back period to use. It just created one common approach. The issue that then came up though was that you could have the ability to add charges to the product itself, and to create a better return. And so there are a couple different ways that you could add charges to create a better indexed return. One is to just gross up the charges in the product itself, and some companies were doing that post AG-49. And another way, which is the approach John Hancock took, and we still take this approach, is to add indexed options for an additional charge that can give you extra upside. And not surprisingly, I really like the second option because it gives customer that choice between which option they use. However, when companies started doing this, the committee had issues with both designs, and the solution they came up with, I think, was actually really good. Essentially, the committee came up with, and it's a sort of a three-tiered way of creating a maximum illustrated rate. But I think the most important thing to understand in that lever is that in no circumstances can you illustrate more than 145% over your options budget, or I should say 145% of your options budget. And so that, I think, is I actually think pretty clever solution to this, because what it did is it really truly tied illustrated performance to the carrier's general account. Excuse me. Just some simple math for how that might work. Let's say you have carrier A and their general account is earning, let's say, 5%, and carrier B, their general account is earning 4%. So carrier A has 100 basis point higher yield over company B. That means you apply that 1.45 factor, and carrier A could not illustrate more than 145 basis points better than carrier B. Now, there's a lot more to the calculation, and there are other factors that can limit it. But that being a key limiter, I think, really does bring these products into line. Now, we've only sort of been in this environment for a couple months, so we're still seeing how carriers are adopting. But I think by and large, you're seeing carriers get in line, and we excuse me, we have seen a lot more simplicity in the design, a lot more sort of consistency in how carriers are moving. Now, one other thing that's interesting about that general account tie-in is carriers have to update annually what their general account rate is for the purpose of that factor. So I think just in the start of the year, you're going to see a lot of index ULs update their products and their illustrated rates to factor in 2020 reality, which, as we know, isn't a great year for interest rates. Just pardon me 1 second, please. So that leads to some implications. I think what are the main implications for carriers, for producers, and for customers? The first is, as I said, I really think indexed UL now is truly tied to companies' general accounts. And I think that's a really good thing, because it's same as UL, same as whole life. I really think it puts index UL in its proper category as sort of the highest yielding option of a fixed account product, with some caveats, but I think just by and large you can sort of put it in that category. I think one other implication is, well, companies will adapt. They're going to continue to innovate. And I think we're just starting to see, and we really haven't even seen yet, how companies are going to maneuver. My hope for the industry, though, is we really focus on true innovation, which is about creating real value for customers, and not about illustration gamesmanship and how to create some extra points. The third, I think, implication of this is that VUL is going to look more attractive. It's going to continue to look more attractive. If you recall, at one point, VUL was 50% of industry sales. I don't think we'll ever get back to that. That was around 2000, right before the dot-com bust. So it wasn't the best time to get into VUL anyway. But it has great features. It has transparency. It has choice. It has upside. I think that's going to be a big part of not only John Hancock's portfolio, but other companies going forward. And I would say, as an insurance producer, and I know a lot of people are questioning maybe they haven't been securities licensed, should I, or I was securities licensed. I do think that VUL is going to be a big product solution going forward. And then the last, thing that I'll say is that, just from a John Hancock approach, our approach to designing products is going to, continue. And really, I don't, wasn't affected by, this change. We really do try to strive on providing real customer value. And so I'll just say, a few things about, how we approach product development at John Hancock. The first, I'll start on that top right about stable policy designs. We really test our products for many different markets. We want to make sure that we're good in low interest rates, high volatility, low volatility. And the benefit for the customer is that you can have a product that can perform well in any scenario. That can be a big issue with some of the indexed UL products that came around. And we're proud that our product performs really well in a number of different environments. Hopefully, many of you were able to listen to Jennifer White and listen to some of our focus on living benefits. That's a huge priority for us. She spoke today about the LTC rider. We think that's a really big part of the insurance solution. Also, of course, hopefully you're aware of our Vitality benefit. Vitality is really about sharing value when customers, are able to improve their own health, and they can share that value with the customer. It's amazing how much, we can make as an insurance company when after somebody buys a policy, they improve their health. If they buy it as standard and they get healthier, they buy it as super preferred and they get healthier, they buy it as a table 8 and they get healthier. When somebody's improving their own longevity, insurance companies make money. And our Vitality benefit is a really engaging way for us to share that benefit. And we really try to share it 3 ways, not only with, the customer, but also with the producer. And of course, that we benefit as a company as well. We think, this is just a great opportunity. I think with health being such a focus, and with the ability to, provide meaningful discounts on insurance, sometimes up to 10%, that can have a major impact to a premium, especially when it grades up. There's no cap, on that premium. So whether you pay $2,000 or $200,000, customers can really benefit by, improving their health. And we're seeing the outcomes now that we've been at it for 5 years now in the Vitality space. We're actually seeing our customers, do things like lower their weight and improve, other biometrics. The third piece is clear customer choice. We always want to be able to provide, not just indexed UL, but variable, fixed UL, term. We want to be able to provide solutions, a portfolio for all seasons, and we want to make sure that you can explain our products and the choices, the fundamental choices, to our customers. And then the last thing I will say is we've really focused on our general account performance, and it's been a major focus of ours. And it really started to pay off immediately after the financial crisis, going all the way back to 2008, to just be really focused on the types of risks we would take, how we would, invest, what types of products we would build. And we've been able to, weather what has been just an extremely difficult storm. And I would be remiss if I didn't talk about some of the latest, news, because we have, like many other companies, been adjusting crediting rates, and we have another crediting rate adjustment for both our indexed UL and our protection UL product coming up on March 1st. And I do want to talk a little bit about just that product itself, because I know, we know that this has been a big product. We've had a great partnership with Algren Associates in this, and it's a product that's near and dear to my heart, since, I was product manager way back on the left side of that graph in January 2011 when we first launched that product. And I want to talk a little bit about it because I think it reflects, kind of our focus in this really challenging interest rate environment. We've been selling protection UL. It's been our core flagship product for 10 years now. It's a different type of current assumption UL. The underlying asset strategy it's not indexed UL, but it's also not all fixed investments. There's a sizable for the portfolio of that product that is invested in alternative long duration assets. And we built that product because we knew we needed a product that could perform well in any interest rate environment. The crash, and we're not going all the way back in this graph to 2008, but that really showed originally that we needed a product that could perform whether interest rates go up and the customer benefits, or if they stay low and go down, that we're still able to provide meaningful customer value, and we're still able to outperform other current assumption ULs, and that's because of that investment strategy. So while it's not impervious to to the interest rates, and we've had to have crediting rate actions, starting at 5.2%, and as of March it'll be 4.35%. And then there's some adjustments too if you're doing business in New York. It's a different it's a lower crediting rate there. But the story is still the same, which is that it's been able to still weather that storm, still continue to offer the lowest premiums in the market, and most important for us and for our customers is still provide strong value for our customers on the in-force side. Yes, it does require obviously management when you have current assumption, you have crediting rate changes and policy management, but we have the tools in place and still the customer value in there to help our customers. So that's a little bit of a sidestep on protection UL, but I thought it was worth bringing it up to this group, and we'd be happy to speak more to it on the Q&A. I now want to move on to Section 7702, because this was a really interesting development that I think caught a lot of us by surprise. We've kind of put our computers away after Christmas maybe, and kind of get back to work on January 1st, and you find out that this small piece of the tax code that's so important for life insurance, which essentially defines what is a life insurance contract, was adjusted for the first time in since like the 1980s. So what happened? The key thing is that it changed the interest rate assumptions that are used in Section 7702. If you recall, for those of you doing business in the 1980s, interest rates were significantly higher than where they are today. Both the cash value accumulation test and the guideline premium test, they have complex calculations, but both of those have interest rate assumptions embedded into them, and it's sort of a minimum of situation, but that one of the floors is hard coded at either 6% or 4%. So you can think of it as zero interest rate environment. That creates a lot of challenges. It creates challenges in UL and index UL. It creates even bigger challenges in whole life. And you saw, for instance, the companies that had 10-pay whole lives that had to move those to 12 pays. It was really because of this interest rate assumption. So the change was a surprise. The change that happened, the interest rate changes, it was introduced originally back in May. In that, if you recall the HEROES Act, that act was shelved, and then it was added to the COVID relief bill of all things, and signed into law on December 27th. So the new minimums that are now allowed interest rates, those minimum interest rates aren't hard coded at 6 and 4. They're now tied to corporate bond rates and a new rate that's derived from, I think it's an average of midterm federal rates. Hopefully you don't have follow-up questions on how exactly that rate is. I think the important thing to understand is it's floating and it's lower. So what's the impact? So the biggest impact is going to be on policies and their sort of MEC limits, or how much you can put in. And I said that's going to really focus mostly on accumulation sales. All things being equal, you should be able to, once these changes get adopted into products, be able to put more money into a contract. It's not something that's retroactive. So if you sell a policy today and it's using the hard-coded factor, it's not going to change in the future. It's only going to be about new policies going forward. I think when this first came out, the first companies to really act were the ones really focused on whole life and also short pays whole life, because I think that's where it's going to have the most meaningful impact. And so I would expect those companies to act sooner. And I think it is very welcome news, because if you recall, at the end of 2019, going into 2020, we had to update our mortality tables to the 2017 CSO table. And when we did that, essentially the maximum charges were lowered in the contract, which lowered how much you could sort of lower these guideline and cash value accumulation test limits, and that limited how much money you could put into an accumulation product. So my hope is that we'll be able to get some of that back. We're not going to get all of it back. I think that's very unlikely, but I do think we'll see some improvements in accumulation sales. I'm sort of veering in from sort of the official company response. I'll give you, just JJ Bowman's personal opinion responses here. So, just as an observer of this, I do think this is going to be a net positive overall. I do think, though, we might not appreciate how tricky it's going to be to implement. The charges, this interest rate, it's not just about going into a contract and saying, well, I'm going to swap out this 4% interest rate and I'm going to put in a new interest rate. Those charges that sort of depend on that interest rate assumption are going to not only set your maximum charges and going to set your sort of limits in terms of your non-MEC limits. It's also how you set your current charges. Oftentimes, it's tied to compensation. So really, you're going to have to, I think, as a carrier, go through a pricing exercise to figure out how best to incorporate these changes into a product. So I think it's complex. I think it'll be needed to sort out. I think whole life companies are going to act sooner. But I do think ultimately it's going to be a benefit, because I think it's, you take any tailwind you can get, especially in this environment. I would think too, just trying to put myself in your shoes as an advisor. I would think of it more as business as usual. There are a number of things that change all the time. You're constantly having to work on, new products are coming in, old products are leaving, some products are improving, some products are getting worse, and you have to make what's the best, kind of the best deal for your customer. I did have a few people call me, when this first came out and wondering, should I hold business? Should I just wait a week? And I just don't think that's the right plan, because as I said, this is going to be tricky to implement, and you could easily have an accumulation product get repriced that has the benefit of, improved, improvements over here, but there may be some other things that sort of cost, on the other side. So it's sort of it might end up being a wash with a certain company. So even though I think this is a positive development, I would say, just business as usual from an advisor's perspective. You want to show the best product now. And, of course, you want to make sure customers are aware of what's going on. But ultimately, you got to just kind of deal with the products that are available to you at the time. So that's it for 7702. And then the last thing that I wanted to discuss is just sort of looking ahead here at the major trends affecting our industry. Just give a few minutes on that. And then I think we'll have plenty of time if there are any questions to go through. So, I see four major trends that have really affected our industry in the 2020 pandemic year. And of course, this is to say nothing of, all of the sort of societal trends, the health trends, and everything else is just affecting our lives day to day. I'll just keep it focused on, just, the specifics of the life insurance industry. The biggest is what I call even lower interest rates. You're seeing more companies take action, as I noted. We're going to be taking action again on March 1st. It's just, it is a really, really challenging time for companies that, take in a lot of premium, invest that on behalf of our customers. And, ultimately, we want to be around to pay all those claims, right? That's why we're in this business. So the life insurance industry, we've been really it's been a challenging time. That's clearly going to continue. I don't think it's all bad news, because, John Hancock's been around, 150 plus years. Many of the other companies that have been presenting today, have been around for 100 plus years, gone through every single, sort of situation that you can think of. So we know that, we do really think long term, and we're going to get through, we'll get through this as well. I think one immediate thing, as I said earlier, is I do think VUL is going to look more attractive, not just because of, what we talked about with AG-49A, but just also with low interest rates. There are going to be better options, I think, in separate account products. So I see that as a key trend going forward. Um, Economic uncertainty was another major trend we saw, and how it applied, I think to John Hancock. One thing that we saw was we got a lot more term business last year than we expected. And that's good in many respects. Not good in two respects. One is we know there are a lot of permanent insurance buyers who sort of push their decision into 2021. I think that's a great opportunity for us collectively because people do need to get insured. We have a new administration coming in. There are going to be, especially in that high net worth space, there are going to be real needs for planning and executing on the planning, and we can't just, people can't wait forever to kind of, solidify their financial plans. So I do think that's going to be a benefit, to us in 2021. The other thing that was, it wasn't unique to John Hancock, but we were definitely, we were hit really hard. Which was to our service, to just our overall new business service. And I know, many of you on this call may have experienced that. I know, Rich, we, put you through, so much of a challenge for it to, help, you did such a great job to help people sort of manage this as best we can. But we knew that our service just has not been up to standard. We've been overwhelmed. One, I think, positive step that we just took is we are temporarily increasing our minimum term face amount from to $750,000, and we think that can if we look at our term sales last year, there was just a huge volume that we got in that below $100,000 to $750,000 range, and this is a temporary thing that we're just going to do to improve, to get sort of a handle on our service and focus on the highest value cases. And I think that's going to help us sort of clear out the inventory. The other thing is we've been investing very heavily on some digital solutions and sort of back office enhancements that are going to pay off in 2021. So we really do expect this to be better for us in terms of service next year. In terms of selling, obviously remote selling, change the way you work. It also changed the way that customers buy insurance. It really changed underwriting. And so, service sort of was sort of a big negative for us at John Hancock, but the underwriting innovation was a huge positive because we've always been investing in underwriting R&D. And this was an opportunity for us to, once we sort of had to act and had to figure out ways to underwrite non-invasively using other means, just being able to make decisions, for instance, based on an APS without, fluids, because it was just hard to get an examiner into a customer's house. I think we were able to make some real changes, and I think the big positive for you and for our customers is I think those are going to stick into the future as well. So I think we were able to adapt quickly. I think the industry is going to adapt quickly, and I think we're going to move to more sort of what I call fluidless underwriting solutions. And I think that's just going to grow the pool of potential, insureds because of just removing friction from the process. And then the last thing I'll just say is back to personal health, which obviously is, such a big focus, probably second only to the actual loss of life, is just individual health and being a focus for us. It's one of our biggest societal challenges, whether it's, comorbidities, obesity, but, we need, people saw the importance of sort of entering, difficult times in the best of health. And we really are committed. That's sort of our main focus is trying to, as a life insurance company, how can we help? And doing much of that through our Vitality program. But we think that the personal health, having solutions, having life insurance products is important. Having life insurance products that create shared value in which we can help you improve your health, and we can reward you for improving your health. I think that creates a great opportunities for 2021. So that is the end of my prepared remarks. So I'll just say, lastly, thank you. And I have not been peeking over at the chat, so I don't know if there were questions here. I see, Brandon, it looks like
Yep.
You're coming on.
Yep. We have.
I see a muted. It looks like you're muted. That
Am I? Can you hear me?
we were just.
Can you hear me, JJ? Yes. No. Maybe.
Let's see.
Can you hear me? JJ, can you hear me?
Hear me? And so I don't know if any people are able to. I see the chat in the on the left side, but if anybody does have a question, I'm not sure if they're able to pipe up and speak. I can't hear Brandon.
Oh. Okay.
But if others do have a question, please just type it in, or hopefully I can hear you. I just can only hear Brandon. Or Allison, maybe you can translate and just type in everything Brandon says into the chat, and then he and I can finish this. The joys, I really cannot wait to see people in person. I really think that's going to be, hopefully we have a chance to do that in 2021. So Brandon's question, was with the lowering of the assumed rate, does that mean that the guaranteed rate on whole life, the guaranteed rate on whole life will change? I don't know, and this is where I'm not the best representative, since at John Hancock we do not manufacture participating whole life products. So I'm going to defer to our, to your whole life, carrier representatives. The one thing, though, I think is very safe to say is the accumulation-oriented whole life, the people that develop those products, I think are most excited about this change. So I think you're going to see the best sort of enhancements there. Again, it's still going to be work, though, to go through. We did do a carrier. We were part of LIMRA as an organization, industry study organization, and I did see responses from various carriers on how they would be, how quickly they'd be acting. I think one whole life company said we'll get around to it in 2 years, which kind of made me laugh. Another said they would be acting very quickly. On the sort of indexed UL side, there was a mixture of we're looking at it to, we're going to be moving quickly. So second question, some insurance carrier insiders are speculating that reducing the carriers that amount at risk and overall COI would cost them revenues and in turn force them to, so I like that question. The question is, are companies just going to cut commissions to deal with this? I think that's an extremely simplistic view of how companies go. And what I was saying earlier is it's really complex. If you just come in with a lower rate and you did nothing else, you might, just by the nature of that change in your product design, you might end up cutting commissions more than you want to. There is still going to be, one of the beautiful things about this country is how competitive the marketplace is, and being able to provide compensation that is market competitive is going to continue to be an issue. So I would very much bet against that happening. In what my counterparts at other carriers, like, nobody's interested, I think, that I've heard, in squeezing out agent commission as part of this. I think it's just, how do we mechanically make everything work and create a good value? So how will Section 7702 benefit the pricing of protection UL? And the 7702 won't have a real impact on protection UL. The sort of governing factor on that product and sort of the rates that we can charge is really driven by the cost of insurance and interest rates, sort of our current mortality, I should say, and sort of economic conditions. And with protection UL, since paying a non-MAC protection UL premium, it's a design we almost never see. We're focused on our two accumulation products, accumulation IUL and accumulation VUL, as the products that we'll be updating first for the new 7702 guidelines. Third question is, can you explain Hancock's unique position based on the difference in gap accounting between, I think that's Canada and the US, USA? Absolutely. So I think, to understand this, it almost helps to go back again to 2008. I have a tendency to pretend the whole world started there, but it really was from John Hancock's evolution perspective, such an important time. But The international accounting, it was Canadian GAAP back in '08. It's called IFRS now. That is the way that companies that are domiciled in foreign countries, that have foreign parents, I should say. So John Hancock is a part of Manulife Financial, which is Canada's largest financial institution. That they use what was called mark-to-market accounting, and still do. And in the U.S. GAAP accounting, there wasn't this focus on mark-to-market. So if you remember back after '08, there were a number of international companies that exited the market. Sun Life was in the US and they exited the market. ING pulled back, Transamerica pulled back. I think Allianz at the time pulled back. I mean, just so many different companies had to pull back because of the mark-to-market accounting. We were able to pivot our product design and focus on products like Protection UL and like really every index UL product we've sold that are very that have different sort of characteristics. And one of those is that we have to test. One of the things that IFRS requires is they really punish you for having volatility in your earnings. And so we have to test our products under a range of scenarios, whether it's shock scenarios and volatility or low interest rates. And by, I think, going through that sort of rigor, and that we've been forced to because we have to build products that succeed both on international and US accounting, I think that's really helped us when I talked about that pillar of stable policy designs, because we just, from an accounting perspective, have to manage through that. And I think there's a real customer benefit. So to me, that's a real positive. All right, Brandon, I wish I could hear you, but you did a great job with the silent stuff.
Well, thank you. Sorry you can't hear me. For everybody else, thank you so much for coming today. I want to thank all of our carrier sponsors today who were with us: AIG, Prudential, Security Mutual, Legal General, Principal, Lincoln, Hancock, and Nationwide. To everybody still here, if you want, we are going to leave the networking feature open until 6 p.m. And then a huge thank you to Rebecca Katzenberg for helping with all the behind-the-scenes marketing and making sure I didn't overlook anything too small. Yes, JJ, you're right. Good job. Thank you again, everybody, and we'll be in touch. We'll see you soon.